We've got 2 minutes to go until we wrap up the trading week. We want to bring in Jay Jacobs. He's Global X ETF Senior Vice President and Head of Research and Strategy. We also have Michael Jones, Chairman and CEO of Caravel Concepts. First, let's get over to Jared Blickery because it's been quite a wild ride this week for the markets. Jared, as it stands right now, at least for today, we still have the Dow in the green.
Yeah, we do. S&P 500 just turned negative. Looks like we're going to sit on some small losses for most of the indices. Notably, the NASDAQ, the dealer network, will probably finish the week in the green by just a little bit. And also, we're looking at the 10-year T-note yield down about 2 basis points. Hasn't really caused too much of a disruption. I was watching some of the comments from Fed speakers today, and they did send stocks south a little bit, but I didn't see that reaction in the bond market. So I am taking that as a bit of a positive that, in fact, the market is prepared for the Fed to start thinking about tapering. That's a big relief, isn't it? Except, what about Bitcoin? We've seen a huge sell-off in Bitcoin. We saw that happen Monday, and we're fishing around for a bottom here. We could have gotten it already, but due to the technical damage, and we were talking about this earlier today with somebody from Investors Business Daily, due to that technical damage, it's probably going to take a few weeks at the minimum to find a bottom and establish that institutional support again, probably a few months. So we'll have to be on the lookout for that as well. 30 seconds to the bell here, if you guys can hear me. It's been a turnaround day for some of the value and cyclical markets. Tech kind of taking it on the chin here, but overall, it was a constructive week for the FANG stocks, especially some of the big mega caps that have been suffering earlier in the year. So now you hear the bell behind me. I'm gonna go quiet and count down until the final bell of the week, guys.
Put a fork in it. We got a closing bell. We're just waiting for the gavel to fall. And once we hear the bang, we're going to see where these markets look like they'll settle. The Dow will be up about 130 points. S&P 500 down about 3 points. The Nasdaq's going to be off about 64 points. Some of the sectors we were just talking about, energy sector, for instance, is going to be positive, but just under about 0.5%. Consumer staples essentially flat. Losers in the sectors today, consumer discretionary off about 0.5%. Information technology also off about 0.5%. Let's go to our guests, Jay Jacobs and Michael Jones. And let's start with you, Michael, because you've been talking about a needed pause in the bull market. It's nobody can time a market, but how long a pause? Are we just going to keep going up and down all summer?
No, I think we're probably getting close to the end of this sideways chop. And I do think it's been a pretty healthy sideways chop. It's kind of taken out some of the speculative excess. The biggest pullbacks have been in the most pricey names. That all feels very healthy to me. I also think that, the big concerns that the market has had about inflation, well, you only care about inflation if the Fed cares about inflation. And the folks on the FOMC who were sounding a warning bell, maybe we should start talking about tapering. Since that meeting, a lot of the data has come in weaker than expected. They look a little bit like they might have been jumping the gun. And I think that gives the more dovish folks ammo to push that conversation about tapering further out in time. Meanwhile, you got earnings continuing to come out really, really strong. So if you push the taper talk out, there's no reason for the market to get back on the rally train.
Jay, how are you looking at the recent action that we've seen? We've seen a bit of a flat action here with the Dow and the S&P. NASDAQ, obviously a bit of a different story, under significant pressure over the last month. Are you viewing this as a buying opportunity here for some of those bigger tech names?
Yeah, absolutely. I think, this has been a little bit kind of like a duck on the pond, right? If you look at just the broad market indexes, it seems like the price action has been okay, but there's clearly been a lot of noise going on under the hood. The spreads between the NASDAQ and the S&P or the Russell 2000 have been very wide over the last few weeks, showing that there's been a pretty significant cyclical rotation. I think that has oversold a lot of these NASDAQ stocks, especially those that were hot in the stay-at-home economy. Zoom is not going anywhere. It's become a part of our daily lives. And even as this pandemic comes to a close, I think a lot of those companies that really kind of broke new ground during the stay-at-home economy are likely here to stay and likely to be on an incredible growth trajectory going forward.
To follow up on this, though, Jay, I just wanted to ask you real quick, because you had recommended, different kinds of ETFs, whether they be fintech or robotic. Is that really where, as an investor, we should be looking and not necessarily at the big stay-at-home technology names or even the big names like an Apple?
Well, so we're calling this next stage the new normal economy. And in the new normal economy, the health risks of the pandemic are behind us, but the lingering economic impacts are still very much with us. That includes the consumption issues or the surge in consumption that we're starting to see as people go back outside. And what does that mean when you've been using an app or you've been ordering online for a year? Well, that probably means people will continue to use some of those digital habits, even if they can go back to restaurants. We've seen supply chain issues that have led to inflation. We think that's going to be a major accelerant for things like robotics. So a lot of these new tech areas that I think are going to really do well in the new normal economy are those that are helping consumers consume and helping suppliers supply.
Michael, what about crypto? We have Bitcoin off another 10% today. It certainly has been quite a volatile week looking at many of those cryptocurrencies. What does this mean, though, for the broader market? Is this a potential risk that you're keeping a close eye on?
I actually think that the crypto volatility and the big pullback that we've seen, again, think about what the things that the FOMC, what they were worried about was they were worried about some of the inflationary pressures, but they're also worried about speculative excess in some parts of the market. And clearly crypto was one of the things that they were worried about. This big pullback, I think, is reassuring to Fed policymakers that they can keep the printing press going a little bit longer. I also think we need to recognize that the deal with cryptocurrencies has always been how long will governments allow crypto to kind of invade their turf and get into their monopoly that they've had for thousands of years on currency creation. And I think what you've seen from both China, but I don't think there's been enough focus on what the IRS released this week, where they essentially said crypto is going to be kind of de facto evidence that you could be a tax evader and you're more likely to be audited if you are using cryptocurrency. And you're going to have to report all crypto transactions above $10,000, which is just like cash. So you've got a lot of the disadvantages of cash with the reporting requirements, with the additional issues of transaction costs and taxes on crypto. So you're seeing a regulatory crackdown from a lot of governments because, frankly, they don't like you being able to evade their monopoly on currency creation.
Michael, I wanted to follow up with you on something that's very easy for old-fashioned investors to understand: demand and airlines. And you've talked about in your notes that we could see the airlines explode essentially as the summer demand picks up. But yet we got from Southwest earlier this week that while demand is going in the right direction, not quite as strong as they thought. They were expecting capacity to be 90% in 2019, but it's actually going to be around 87%. So it's not happening as fast as perhaps people like you expect. Is that a reason for an investor to say maybe I should hold off?
I still think ultimately the thesis is the same. What you've had, the airlines have had an opportunity because of the pandemic. They could make a real cost rationalization across their entire cost structure. And as they're bringing capacity back online, they're bringing back online that capacity very carefully and measuring it relative to the demand that they're seeing. I still think you've got an industry that's extremely fixed cost intensive. And so any efficiencies they get have a huge leverage into the bottom line. And I think the explosion in demand is inevitable. It's just a matter, is it summer? Is it fall? Do we have to wait till next spring? I still don't think it's priced into these stocks, and I still think the upside is very, very strong.
Jay, how are you viewing the reopening play? Because it's not just airlines. Of course, we got the news this week on cruise lines. Some of the cruise lines here mapping out their restart this summer. Are you seeing some opportunity there or still a bit too early?
No, I think we're seeing reopening happening pretty fast. Again, this goes back to this concept of the new normal economy. People are getting more comfortable going back into offices. They're more comfortable going into restaurants. That's really opening up consumers' wallets. They've been saving up because there's been so little opportunity to spend. And now that's really bursting onto the scene. We're seeing it. We actually saw slightly, disappointing retail sales, but I think we're going to see an acceleration in retail sales in the coming months as people really kind of emerge. Again, that leads through fintech. I think a lot of names that are facilitating digital payments are going to be really well positioned. The reality is you have so many different ways to buy something these days. You can pay with it your credit card, your phone, your watch, online, app, crypto. The companies that are integrating this complex web of ways to pay for things in different environments are really going to be channeling a lot of this revenue as consumption explodes. So I think fintech and digital payments is really ready for an incredible summer.
All right, as we wrap up the week, let's head back over to Jared Blickery, who's on the floor of the New York Stock Exchange. And Jared, I guess, what's your big takeaway? There's so many different angles you could go from this week.
Oh, you bet. But I'll tell you what, the crypto winter is here. It was 1 week ago. I was sitting at home broadcasting, and my final thought then was we could be seeing a crypto winter entering in the summer, except it's actually the winter in South America and the Southern Hemisphere. Just building upon the comments of the previous guest, it's going to take a while here to find a bottom, but this does give some relief to some of the regulators, Fed chiefs, and central banks around the world. They got a little bit more time on their hands.
All right, Jared Blickery, thanks so much. And of course, wrapping up our first week back on the floor of the New York Stock Exchange. Always great, Jared, to see you down there. And of course, our thanks to our two panelists, Jay Jacobs and Michael Jones. We look forward to having you back here